A trader with 15 years of institutional trading and an additional decade managing institutional teams.
Losses loom larger than gains. When people are faced with big holes to climb out of, there is a need within them to try and recover as quick as possible. That's not the right behavior for trading. You're not trading well to get to this point. So why is it right to start fighting to get back when you should be reducing your size?
James Thorpe, a professional, seasoned veteran within the futures markets. And in this episode, we explore his experience managing teams of hundreds of professional traders, going over their strategy, risk, psychology.
I try and steer away from the belief that you need to eliminate all your emotions in trading. I feel like that's an unfair ask. One of the big things that gets people into trouble is having the wrong. You can't predict the future. What you're trying to do is trying to think 1 or 2 steps ahead of what the market is doing. Is it price long? Is it price short? Is it panicking? I always found it very useful to play through these what-if scenarios. Doesn't mean I got it right, but it meant that I was prepared. It just backtracked on tariffs. Instead of like, what does that mean? I've got a game plan in my head. I'm going to go for it. Rather than having to think through the scenario. Now I want to put that position on, but it's too late because now the market's moved. In 2010, I moved to Shanghai to manage a professional trading group. It was just about breaking even. I was kind of bought in to help knock it into shape.
What was the needle mover that you took it from a break even to profitable? As you mentioned, there's technical, there's fundamental, there's risk. What was the things that you found beneficial in application to profitability?
It's a good question. I think
you have professional experience with real prop firms and large capital and multiple continents, and now kind of delving into the retail space also. With the experience that you've had working with many traders from both sides, what is the big difference you see between the behaviors or the resources or the access to information that a professional trader and a retail trader would have?
that's a very big question. One specific part that you asked there, what's the difference? The access to information. And I think this is interesting because as a professional trader, I traded for 15 years. And when I was struggling or found it difficult in the market, I always felt like somebody, like maybe a hedge fund or a trader in a bank, would have more information than me. And then having worked with banks and hedge funds, I've also found out that those traders feel like someone has more information than them. And of course, the retail trader always feels like everybody has more information than them. And I think this is a bit of a myth to that when you sit on a bank desk and prior to the change in proprietary trading rules in the UK and Europe, I think around sort of 2010 to 2012, bank traders will obviously have customer flow, so that would help them give the edge. But generally speaking, everybody's looking at the same prices on a screen, right? Everyone's looking at the same charts, and so I think there's a belief that people are always in the dark, and it's not necessarily the case. It seems to me that every trader, no matter what level they're at, retail, professional trader, bank trader, hedge fund trader, always feels like they're missing out some information. Yeah,
definitely a misconception on my part then.
Yeah.
In which case, what advantages in general does a floor trader have? Because if it's not necessarily information, I'm sure then it's the environment, whether it's less responsibility of risk or access to teams of information, so individual responsibility is diminished.
Yeah.
Are there certain advantages you experienced in the professional side that a retail trader doesn't have?
Yes. So I would call that the difference between that, and this is the challenge for a company like mine, Trade Day, that services retail traders at home. And the difference I feel is like active management versus, if you like, passive management. So if you're working in a trading room, if I just take a step back and paint a picture for you, in 2010, I moved to Shanghai with my family to manage a professional trading group. There was about 50 traders in there. It'd been operating about sort of 2.5 years. It was just about breaking even. It wasn't really making any money. And I was kind of bought in to help sort of knock it into shape, right?
Okay.
Introduce the training programs, a more rigorous risk management structure, help with recruiting, operations, everything from the top down. And what I found, what we would do is we would have a desk of new traders, and on that desk of new traders, we'd break that down into 6 guys, and we'd have a more senior experienced trader sitting with them. and then we would have meetings every day with the whole team. We'd have, meetings every day with the whole group, and then meetings every day with the team, and then probably once a week I'd have a meeting with the senior trader that was sitting with the 6 juniors to go through each individual's trading, what's their strengths, what their weaknesses. Are you ready to take on more risk? Should they be taking less risk? Should we move from live markets to sim markets to live markets? This very active way of managing traders. From what I do now, which is like run an online prop trading firm, or as we like to call them in the United States, an evaluation service provider, you can't do that. You're providing a service. So what we do is we create a lot of coursework to help traders with what I call the 4 pillars of becoming a successful trader: risk management, psychology, technical analysis, and fundamental analysis. And we create coursework around that, but we can't necessarily mandate the trader take that coursework. Right. So what we try and do is we try and nudge them along, particularly when they've made it through to our live trading team, and we're really trying to nurture them at that point. We will, be a bit more proactive there. But again, you're very much hands off, and it's very much passive. And for the trader at home, it's very much a lonely world, right? You are your own risk manager. You are your own educator there, and you don't know where that information or where you go to get that information. You don't necessarily know if it's legitimate or not.
It's also interesting because I imagine in the professional space, you have kind of cutoffs where at a certain risk tolerance or at a certain lot size, let's say, or contract size, if you want to act more, you can't. So these behaviors of fear-based trading, revenge trading, or greed, you can't express them even if the trader maybe feels it. Whereas in an at-home environment, it's free reign, which is probably to the detriment of many. Yeah, when absolutely. You were relocating from the UK, I guess, to Shanghai, and you were brought in, it was a break-even, firm, what should we call it? Yeah. What was the needle mover that you took it from a break-even to profitable? Because as you mentioned, there's technical, there's fundamental, there's risk. Yeah. What was the things that you found beneficial in application to profitability?
Okay, so I would say there's probably 3 elements to that. The first one was probably luck and timing. Really? These guys have been at it 2 years. I don't want to take all the credit. The second one probably was what I found. There was a very strong focus on technical analysis. And I see that today in retail traders. And when I do mentoring with retail traders, there's a very strong focus on technical analysis to the detriment of other more important aspects of trading. And I've seen many career wasted by traders looking for answers in charts. And, you'll have this conversation. I mean, I went through this journey myself. I traded for 15 years. So, everybody goes through this journey. But it's like, if I can just change that time frame, perhaps if I just, change that calculation, this will, increase the probability of me being right. And it's just this continued focus on technical analysis at the expense of things like psychology. Right. So like one of the main things, the 2 main things I brought in, I would say risk management and psychology. And we spent a lot of time, I spent a lot of time talking about how I handled my losing days, how I handled scaling up, how I handled my emotions with the traders. And I think that started to have a real impact. And then the other thing I found was even in a managed environment, the traders were over leveraging, even the new traders. Wow. And it doesn't sound like much, but a trader had been with us sort of 3-4 months and was struggling to make money, and they're sort of trading 5 and 6 and 7 lots. And it's like, why are you trading 5 and 6 and 7 lots? You're not making any money. And what you're doing is you're digging a deeper hole, a bigger hole for you to get yourself out of. Let's step back. I mean, I used to draw a picture of a swimming pool, like a profile of a swimming pool with a shallow end and a deep end. Okay. And you guys are all flailing around in the deep end. Let's move you back to the shallow end so you can touch the floor. Just trade 1 and 2 lots. Take the pressure off yourself, right? Make the education curve or the length of time that it's going to take you to sort of get to a break-even trader and then become a successful trader. Let's make that cost of that lesson, that length of time, as little as possible, so you're not facing big losses to recover from. And that's the way I was taught back in '94.
Off the back of this swimming pool analogy, whether you're in the shallow end or the deep end, the best move, all you have to focus on is just treading water, staying afloat. And in a trading environment, whether you're in a huge drawdown or a huge winning period, you just got to, what's the next chess move? What is my next play? And that's just an individual decision and then a cumulative effect. Why do you think the environment of I'm losing or I'm on a hot streak can influence that individual behavior when everybody knows I just need to follow the plan? Why does it become so difficult to follow the plan based on the environment of the situation?
Yeah, it's a good question. I think it's human nature, and there was a paper, and I'm going to butcher these names now, but it's by Trersky, and I can't even remember the second gentleman who wrote this paper together, but it essentially, I believe it was called something like "Losses Loom Larger Than Gains," and it's the pain of losing is twice as painful as the pleasure of gain. And I think what happens is that when people are faced with big holes to climb out of, the only way they think they can recover, or there is a need within them to try and recover as quick as possible. And that's not the right behavior for trading. That's a toxic behavior. That's over leveraging. I mean, if really, when you look at it logically, you're not trading well to get to this point. So why is it right for you to start scaling up and get, fighting to get back when you should be reducing your size? And so I think that's kind of like it's something inherent in our nature that causes most people fall victim to that. Even successful traders fall victim to it as well. A successful trader, I feel over time perhaps falls victim to it less often, is more self-aware and knows when it's happening, and eventually can control themselves and take the right behaviors to overcome it. But we're all human, we're all subject to our emotions.
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry, and in the last year they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital.
I think this whole idea of just loss aversion is maybe a survival mechanism that we perceive the threat of losing money as a detriment to our existence, let's say, because finance, obviously, especially livelihood and so forth. Do you think as time goes on, or as a professional trader develops in his career, it's more a immersion therapy, you get desensitized to that feeling, or is there a protocol to follow to kind of manually override that and be in a stoic place, especially when you were guiding traders on the trading floor?
Yeah, that's a good question. I do try and steer away from the belief that's commonly held that you need to eliminate all your emotions in trading, because I feel like that's an unfair ask of people.
Because we're human in the end.
Because we are human, right? And we're driven by our emotions. I think it's about emotional state management and how to cope with that. And one of the big things that I think gets people into trouble is having the wrong expectations about trading, about their own performance, about their own P&L, and this need or drive for perfection that simply doesn't exist in trading. So I think kind of like, those are the sort of like the key markers that a successful long-term trader is aware of. Again, still subject to their emotions. I was... we used to have a thing in England called a schoolboy error, meaning, you were making a mistake that you should have learned in school. And I'm 15 years into my trading career and I'm still making it. I think the difference is you're making them less frequently. And when you do make those mistakes, you have the tools in your toolbox to be able to recover.
When you were working in the capital management, what kind of assets under management were you responsible for?
So it wasn't capital management. It was proprietary trading. So what happened was I was a broker for about 4 years, and then I traded for 15 years. Part of that was on the floor from 94 to 99, and then in London the floor closed. And from 99 to 2009, it was in different institutions, and it was day trading. It was proprietary trading. I was backed by someone's capital for the most part of that time. And it was, some swing trading, some position trading, but probably about 80% sort of day trading, and as I said, trading in professional institutions, so not retail from home, in trading rooms. And then from there, I worked for an exchange for a couple of years, and then after that, I went back to trading, but it was managing professional traders in trading groups. And these were proprietary trading groups. So the group was trading its own capital; it wasn't assets under management and things like that.
I'm very curious to know the archetype of a candidate that either you were looking to hire or within the team that you had, of who you'd identify as a key player or someone that you might give more allocation towards. Was it personality driven, or was it more, I guess, as responsible for risk, you were also identifying he's a great trader but he's on a hot streak, he's getting a bit overzealous now, or this guy's a great trader but he's just a bit too fearful, and kind of orchestrating it from the top. What kind of thoughts would you have, or personality traits would you see, or assessment of risk?
Yeah, it's interesting. The leading driver, I would say, would be performance. Certainly not personality driven. And in fact, that was one of the things we would drive home in our recruitment drives. Would be, one of the great things about being a trader is, you don't have to suck up to your boss. As long as you're turning in the performance within the risk parameters that are set for you. You can be an introvert, you can be an extrovert. You can have any sort of personality type. What personality types would we look for is a very good question. We would hire around 250 graduates from China, Eastern Europe, India, and for a short time in Africa, just from top universities there. And we would put them through our training program. And over time, after about sort of 5-6 months, you might lose half of them. After about a year and a half, you lose a half again. And our success rate was around sort of 20% of the people that came through our door would go on to have successful careers as traders. And out of that 20%, we were desperate to try and identify what were the common threads going through those 20. And I think for any trading institution, it's like the holy grail. If you can identify at the interview stage who's going to make a great trader, you're going to have a great company on your hand. And unfortunately, you just can't do that. We spent hundreds of thousands of dollars trying to do it in developing isometric tests, taking a look at our top 10 trading performers, what's the common thread that runs through them, and trying to sort of design recruitment programs around that. And, it just didn't work.
Was there some commonalities?
There are definitely some commonalities, but I don't really think, when I think about them, that they are any different to what it needs to succeed in any form, in any job. So, we would look for people who worked, who demonstrated a very high level of focus and were willing to work hard. I think, there was kind of a sort of a loosely held belief that people who excelled at solo sports, like marathon runners and swimmers, because the theory was they were self-starters and self-driven and self-improving, and all, this is trading's, you might be working on a desk in a team, but it is really a lonely pursuit. So that kind of made sense. But, trying to sort of identify specific characteristics around someone's personality was
it does make sense, because trading in the end is very almost entrepreneurial, and you do need to have high stress tolerance, a bit of resilience, intrinsic motivation, and these are just common traits for success. So I can see where you're coming from.
If I may jump in, because there were a couple of things in personalities that we didn't particularly hire, or in people that we didn't particularly hire. One of them was we steered clear of PhDs. Now we were hiring graduates and masters, but we found that when we hired PhDs, there was a tendency to try and over-intellectualize the market and try to over-analyze it, and trying to make trying to make the markets rational, and they're not. So they were we found that generally, not everyone, but generally, they were difficult to train, and people who were arrogant or came in and had a lot of experience in trading and felt that they knew it all, they were very difficult to train. And I think what that speaks to on that second part is that it's important to have a level of introspection as an individual when you trade, because there is a lot of work you have to do on yourself, and you have to identify your weaknesses. What are you doing wrong on a day-to-day basis? How are you going to try and fix that? Can you try and fix that? Those types of things.
It's an interesting idea, because the more academic someone is, or the higher the IQ someone may have, it's maybe a presumption that they would excel in this environment. But I was in university for 6 years, so the academic life I was very familiar with. And in that sphere, you're kind of rewarded for passing an exam, let's say. So your feedback loop is, if I fail an exam, let me just go study more.
Yeah.
So you kind of try and intellectualize towards passing.
Yeah.
In the markets, if you do that same loop of let me just study more, let me just figure it out more, it's not conducive towards more profit, let's say. So it's interesting to hear that it's not necessarily a correlation. What about
just one other thing on that, because there might be some people in the comments going, well, what about, I know PhDs that do very well and stuff. What I'm specifically talking about is discretionary trading. And, particularly individual discretionary trading, proprietary trading. You take a look at a company, probably one of the most, if not the most successful trading groups in the world, Renaissance Technologies, that's made up of only PhDs.
Yes.
That's a different type of trading. So
I think they were more developing systems. It was not discretionary trading.
It's much more quantitative, automated, high frequency, that type of.
It's a nice parlay towards what was your experience with the algorithmic trading side and developing those systems?
Yeah, so we spent quite a bit of time at Mercury, which, depending on where we were in the recruitment cycle and hiring and firing cycle, was usually around sort of 750 traders. And most of those were trading discretionary. But we wanted to sort of leverage off the intellectual capital we were bringing into the company. So we were hiring mathematicians and engineers and see if we could build automated trading systems. I was with them from 2010 to 2014, which is really when this type of trading was starting to gain momentum throughout, certainly futures trading, and throughout the US and Europe. And we managed to successfully build I say we, well, it wasn't on my shoulders. There was a successful team out of Israel that had about sort of 3 or 4 core guys with about sort of 7 or 8 support guys around them that developed an algorithm that traded interest rate markets, so yield curves across interest rate markets. And in the end, it was doing about 30% of our volume. So, I'd say a team of sort of 6 to 10 people were doing 30% of the volume that we were doing of 700 traders.
Wow.
So, I witnessed the growth and the success of that. Fast forward some years later, I was in Chicago and hired by a smaller proprietary trading group that was doing some automated trading, some discretionary trading, what I would call sort of black box, grey box, and discretion. And I was brought in to help them develop their automated trading. And I kind of really didn't appreciate, one, how fast the space was moving beneath us, and 2, the sort of financial runway we would need in order to compete. And this is sort of around sort of 2016, 2017, moving into 2018, when a lot of the high frequency, low latency strategies were moving into the single digit microseconds for execution.
Wow.
And then, believe it or not, there were, some very well capitalized firms, and these are the ones that survive today, like Jump Trading and DRW and places like that, who were looking to try and shave nanoseconds off order execution. Oh. So, I kind of had a bit of a front row seat to that. We never managed to make a success of that at the smaller firm that I was with. I still believe that the firm out of Israel is still operating today and doing okay. I'm sure they're finding it. I found it increasingly difficult over the years with the level of competition and things.
So interestingly enough, yesterday I attended an event here in New York, and it was it was a quants event.
Yeah.
And we're talking the smartest minds in the city. And it's just people that are deep in AI, large language models, quants, physicists, and they're all in the finance sphere, hedge fund managers. It was an insane environment.
Yeah.
And I could see all of them very passionate just about AI and algorithmic trading. And it seems like discretionary trading was not even a thought. It was this was the future. I caught one of them at the end of the event and I was asking him about what is his views on the future of it. And he said, well, the ability to make profit in the market is because there is an information gap. And you're exploiting that information gap because I think I'm going to buy it today knowing that someone else will buy it at a higher price.
Right.
So algorithmic trading, in the short term, you have an edge. But then as more AI gets involved, this gets squeezed and then it kind of cancels out. So he was theorizing that it's almost like a pendulum where there might be periods where algorithmics are doing very great because there's a gap there and then they slowly get squeezed out and then it's back to just flat markets and kind of cyclical. Is that something you experienced or any comments on that thought?
Yeah, I think he's wrong. I think there's room for every type of trader in the market, and there always will be. And I'll just explain why I think that based on my experience. So when I started on the floor, we were very much market making, bid and offer, trying to sort of like take a tick out the market and scratch. And that carried on to my off-floor trading on the screens, legging in out of spreads, trying to take, I was manually, basically high frequency trading, but manually with a mouse initially in the early 2000s. And eventually that edge went away. Why? Because algorithmic trading, quantitative algorithmic, high frequency, or let's just bucket it into automated trading came in and was able to do what I was doing manually faster. The calculations, the execution, and without emotion. And for me, that was like, oh, this is it. This is the end of day trading for discretionary traders. And then, I actually, around that time, I left and joined the exchange. And that role took me into business development around the world, talking to different funds, different trading groups, different banks around the world, trying to drive more interest in the exchange's products. And in that role, I started working with proprietary trading groups out of China, India, Eastern Europe, and Israel, and places. And there were people making money, discretionary trading. And, I just came to realize that my edge had been eroded, but there was still edge in there for discretionary traders, And, today we have someone in our live trading account who's discretionary trading and, he's up 150,000, and he's been consistent in his approach and he's grown that account well. And, and he's still managing to do it today. So I feel like there is always opportunity. And somebody used this analogy and I quite liked it. I don't know how good it is, but I quite liked it. And that the market is almost like an ocean. And at different levels of the ocean, on the surface all the way down to the bottom, you have different ecosystems. And within those ecosystems, if we're looking at trading, different types of trading exist. So at the top, you might have long-term asset management or discretionary global hedge fund, global macro hedge fund trading. And at the bottom, you might have low latency, algorithmic, AI-driven quantitative trading that's market making in fractions of a second, trying to take, well, it's not even a tick. Some of these strategies are like quarter or an eighth of a tick out the market because they do multi-leg strategies, scratch, and the cost of that reduces the value of the tick all the way down to a quarter or an eighth.
Wow.
And if you're a discretionary retail trader and you try and swim up and exist in the top part of the ocean, you don't have the deep pockets to run a position offside for 2-3 months like a hedge fund might be able to. If you swim lower, you can't exist in that ecosystem because you don't have the infrastructure, the speed, the strategy maybe, or even the cost of trading. These high frequency firms have memberships at the exchanges that reduce the cost of trading. That high frequency firm might be doing favors to that exchange, making liquidity in illiquid products that they're trying to promote in return for fee credits. So they're trading at very, very low cost, and you can't compete with that. And this is like kind of one of the things that I try and drive home to our traders is that I see a lot of retail traders really trying to scalp. And what they end up doing is, it's a little crude, but they end up like feeding like a chicken but shitting like an elephant. And they'll pick up, or some people used to say, picking up nickels in front of a steamroller.
Yes.
So you're scalping, you're taking a tick, 2 ticks, 3 ticks, and then all of a sudden,
losses.
huge losses. Or that strategy is nowhere near as profitable and can't be run as profitable as somebody in a professional trading group, because your round trip fees, your commissions and futures are much higher to the retail trader, and the professional trader's trading at a fraction. So if you can't compete with them. But there is part of that ocean you can compete with other retail traders, swing traders, whatever it might be. So there is room for all types of trading, and I believe it will remain that way.
I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader 8 and Ninja Trader that are compliant with CME regulations. With the largest end of day balance drawdown in the industry, a 90% profit split and same day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry, to make this a home run offer if you are a futures trader.
There's two things I may infer from here. I just want to see if it's correct. Number one, you said you had an edge and over time it decayed.
Yes.
And that maybe is because you were at a certain level in this ocean.
Yeah.
Or it might be just a law of the market. Do you think at certain points your strategy has to change? It has to pivot? Or
All the time. Yeah.
It's not something like I've got a strategy today and I can rely on it forever?
Yeah, no, absolutely, 100%. Again, I'm just drawing from all these analogies that, people have shared with me over the years. One of them, somebody said to me, trading's like a flu virus. You think you found a vaccine for it, and all of a sudden it will mutate into something else.
I like that.
Right? Mm-hmm. And that is trading. And as a trader, it's your job to continually evolve your trading, and it is a very, very hard thing to do, because when you found something, an edge that works for you, you want to exploit it as much as possible and do nothing else. And when you're struggling, now it's really hard to change your strategy and evolve it, right? Because is it just the market condition that's changed? Is it going to come back? Have I changed? Has my edge eroded? You're asking all these questions. So it's very difficult. And I think, for me, I look back, I traded for 15 years. And in my last year of trading, I was still making money, but my peak had been 3 years before, so I was making progressively less.
I see.
And there's a funny anecdote behind it. I am married, Tara. She was trading at the time, and she was she was pregnant, so she was quitting trading, and she was like, we're about to have a baby. One of us should get a proper job, like a regular steady income, and so that's kind of like why I quit. But 15 years is a long time, and I was kind of getting burnt out of like having to reinvent myself and try new things. And I think that when people talk about burnout in trading, I think that might be part of it too. But you're absolutely right. Trading evolves, markets evolve, you evolve, you change, your risk profile changes. What would have been tolerable and acceptable to you in your 20s might not be the same to you when you're in your 30s about to have your first baby.
I want to understand, this comment makes total sense, but I want to see how someone can actually apply the logic, because I can see both ends of the spectrum where someone might be micromanaging and starting to micro change their strategy on a weekly basis because of some bad losing period that was acceptable losses, versus someone might prolong it and drag it out. How do you assess my edge is decaying versus this is just a low period that is factored into my edge?
Yeah, I don't know the answer to that, I'm afraid. That is a really good question, and that is part of the challenge of a trader. I think a good story. A friend of mine, she was trading successfully for about 15 years, and she said, she would have 3 or 4 losing days in a row, and go, why do I feel I can't do this? I've got a 15-year track record, 4 losing days in a row, and I feel like I can't do it. And I completely related to that. And I know that I've vocalized that myself, a number of times.
Would you attribute that more to then psychology, just life changing?
Yeah, well, that's the psychology of trading, and that's like kind of down to the uncertainty. But having, I think, lived through also, as you say, a number of cycles of having to reinvent yourself? And is this the start of one of those, or is this just a quiet period in the market and my strategy my strategy works better in certain conditions?
Yes.
And I think one of the things you can do is, when you have a strategy, is ask yourself continually, why does this strategy work? What does it rely on?
Okay.
Is it something as simple as it works best in bull markets? And then if it stops working in a bull market, then perhaps that strategy's edge is going. But if you're suddenly in a bear market and it's not working, then maybe it's not time to change your strategy. Maybe it's time to stop trading that strategy, or trade smaller, back off a little bit, but the market conditions aren't right for you. Conversely, it could be volatility. You might have a strategy that's very good in high volatile markets, or works better in low volatile markets. I feel like prior to the Trump administration, we had a bunch of traders on our platform who had strategies that were doing pretty well, and
No
with
longer
the
now.
huge explosion in volatility, they found it very, very difficult.
It makes sense. So this ocean analogy, I really like it, and I can kind of see there's components of this ocean that is not favorable for a retail trader, because we have an information gap or a facilitation of a trade gap.
Yeah.
So there is, let's say, a Goldilocks period. There's a sweet zone for a retail trader.
Yeah.
Number one, if you could help us understand or define what those areas would be for a retail trader to focus on. But number two, do you think off the back of this, of things decaying or changing in the market condition, leading to certain strategies not working as effective as another one, bull market versus bear market, let's say, that as a trader you should be holistic and say, I should be swing and scalping, and I should be developing systems, and then just my job as a trader is knowing when to deploy each trade type or each model?
Yeah.
Or is that then just too complicated?
I feel like my experience tells me that approach doesn't work for a lot of people. Most successful traders that I know are good at one thing or one style of trading. That's what they focus on, and typically one product as well. So they're not trading a big basket of products. Now, there are, of course, types of trading, for example, like asset managers and things like that, that will have strategies that will rely on diversification across different products and asset classes. But they are strategies that are taking automated trading signals. If you're an independent discretionary trader, you're much better off focusing on one product and learning the nuances and the characteristics of that product than trying to be, a master of one trade, not a jack of all trades, so to speak.
Would an undertone of this be that if it's a technical based system, not necessarily fundamentals, or including fundamental traders? The reason I ask is because I imagine there's more nuance to understand in technicals on a single asset class, whereas fundamentals or just understanding the environment, it doesn't have so much nuance on a day-to-day basis, let's say.
Yeah, I think, I think I stand by that, particularly for new traders and intermediate traders. The way forward is to find a market that suits you, find a product that suits you, and focus. Try and become profitable in that product. Don't do too much. I don't really know if this answers your question, but at the top of the interview, we talked about how it's a mistake to focus purely on technicals. And one of the things I do see heavily ignored is fundamentals. Now, retail day trading, there's an argument, how important are the fundamentals? How important is data? Of course, it was the Fed today. That's crucially important to know when that release is. But generally speaking, is it important to know what's happening in the news and headlines? And I think that gets ignored a lot. I think it's very important for a trader to understand what's driving their price. Your technicals could be pointing down, and your gut could be telling you it's going down. But if a data release comes out indicating there is going to be, high demand or a short supply, price is going up. So, I know that it's ignored, but what weighting should you give it in your strategy as a retail day trader or swing trader? I think fundamentals are a lot less weighting than if you're a global macro hedge fund that's trying to pick up big trends that develop over weeks, months, and sometimes years.
I feel like a lot of traders, just looking at prop firm statistics, is more so day traders and
Yes.
maybe even leaning towards scalp traders. So I think this comment of technicals will definitely hit home, because in pursuit of being a day trader, let's say, fundamentals do get ignored, because the logic is, well, if interest rates are this or inflation is this, well, that might take months to play out. How's that going to affect my London session today, where I'm in and out in that session? Where I do see that wisdom coming in. And if you are someone that is a lower time frame or more a day trader, or let's say, what fundamentals should you pay attention to not be overly weighted on just technicals?
Well, first of all, the data is crucially important every day. Like, I am continually amazed that people don't know when non-farm payroll is. First Friday of every month. Depending on where you are in the world, a different time. It hits a different time of day for you. Wherever you are in the world. In London, it was 1:30. In Chicago, it's 7:30. So those are the most important. Like the big, what we call them at trade day, we call them tier one data, and we actually do not allow traders to trade them.
Okay.
A lot of your audience will be familiar with the online prop trading setup, and there was a time when trade day used to fail traders for having open positions going into non-farm payroll, CPI, and the Fed. We no longer do that now, but what we do is we shut off the trading, because it's a complete and utter gamble. And I wrote a whole blog post on why it's a terrible strategy to try and trade data. But as a trader, growing up as a professional day trader, these were key events for you. Like everybody knew when they were happening. Now, the advantage of working on a trading floor is you're standing in a trading pit with 100 people, all looking up at the news wire, waiting for it to break and the market to kick off, so you can start trading. At home, you might forget about it. And I've done that, even in an office. If it's a quiet office, I've forgotten it was data release. I had a position, all of a sudden I'm 3, 4, 5 ticks offside. Like, what the hell's going on? So it's really important, I think, to understand data releases. I think it's really important to understand the general sentiment in the news, and kind of like, for example, what's the impact of tariffs on price? Now, you don't have to understand what a tariff is, and you don't have to understand how it's going to affect the price of a car, for example. But if Trump comes out and says, I'm increasing tariffs on XYZ, you have to really have in your mind a sense of which direction the product you're trading is going to go. And it's hard to judge how far it's going to go, but certainly as a trader, in a trading room, one of the advantages were that you would sit and play out what if games during quiet market times with the people on the desk. What if this is said? What if he says this? What if he says that? What if he retracts that? What am I going to buy? What am I going to sell? Where am I going to jump in?
So the crypto bull market is well upon us, and with opportunities left, right, and center, why not utilize other people's money instead of your hard-earned money? So introducing to you the world's first crypto prop firm, Bitfunded. And they've partnered up with an exchange to bring not only the world's first crypto prop firm, but actually a prop firm that has an exchange-like environment. Imagine as if you're trading on Binance. With all the benefits that prop firms bring, with the leverage you can have, or hundreds of thousands of dollars in buying power, utilizing other people's money, so your total risk is just a couple $100 max, or as cheap as $79. And with the special offer that they have going on right now for you as a Titans of Tomorrow viewer, if you buy 2 prop firm accounts, you'll get a third one for free. So click the link below this video to head over to the Bitfunded website and start to utilize other people's money to benefit from the crypto markets whilst minimizing your downside.
It's also interesting because you may have certain predictions, these what ifs, and the what if may play out, but then the market doesn't react as you would expect. Non-intuitive, because maybe there was another overriding factor that wasn't considered. My view, let's say, is this is also going into, let's say, recently with Trump, where he has his buddies in the White House and saying this made 900 million, this guy made $1 billion, and kind of laughing on the situation, which really throws to me the idea of insider information, or the elites at the top, they're all friends and they all share these informations. The derivative of that is buy the rumor, sell the news, where you might have all your ideas, but in the end, the market will do what it will do.
Yes.
But you may get a sense of the buy the rumor, which is the large players positioning their orders in, and maybe
Exactly.
getting a sense of price action to predict through technicals what the news release may be.
Yeah.
Do you think that's a futile approach, or
No.
is there some logic in there?
I think that speaks to the very key of it. I think one thing that what you're trying to do as a trader is you can't predict the future. What you're trying to do, it's almost like a game of poker, is trying to think 1 or 2 steps ahead of what the market is doing. Is it price long? Is it price short? Is it panicking? You know, where is everybody, and how is the market, or how are they going to react if this changes? And I always found it very useful to play through these what if scenarios. Doesn't mean I got it right, but it meant that I was prepared rather than scrambling when that event happened. Oh, he just backtracked on tariffs. What does that mean? Instead of like, what does that mean? I've got a game plan in my head. I'm going to go for it, and and I'm going to put my position on. And if I'm wrong, it's going to be risk managed and locked out. But if I'm right, I'm going to be able to capitalize on it, rather than having to think through the scenario. Go, okay, now I want to put that position on, but it's too late because now the market's moved. So I think. You've kind of like sparked a memory, inside of me of, it was constantly, the way I traded, I constantly looked at price and what was happening, with the order flow, and trying to figure out, is the market short here? Is the market long? How do they feel? Why have they put that position on? And then I could start to formulate my trade plan around that. But it was more, rather than just, I don't quite know how to articulate this, but it was.
I sense it's like poker. You're seeing the hands being dealt, and you're kind of getting a sense of, okay, buyers are in. Are they absorbing the orders? Is there exhaustion? You're not just seeing the price alone. It's the order flow.
Absolutely, yeah, absolutely. And it was kind of like almost trying to play 2 steps ahead, not 1 step ahead, if you see what I mean. So
there's a book, I forgot what it was, but he made a funny comment, which is, it was to the effect of, trading is a very arrogant endeavor, because you have to take a position and assume that no one else knows what you know, and that you have some arbitrage in the market that no one else can see. The comment being like someone buying an AI stock because, well, AI is the future. Well, the rest of the world knows that's priced in. So for you to actually capitalize in the market, you got to do something that someone else doesn't know. Which brings me on to the question where, when I do see swing trading, unless you have an extreme fundamental edge, or you're looking at institutional intent, which is kind of like a self-fulfilling prophecy. If the institutions do X, then Y will happen, because they move the market. Aside from that, I as an individual, I have a decaying degree of certainty as time goes on. So I might be very confident on where something might be in 5 minutes. It's in a box this big. But if I say, where is it going to be in a year? Well, it's a big box, because there's so much things that can happen in the meantime, or an information gap. Do you think these things then, this trader's arrogance, or just being able to execute on an idea, is more leaning towards, with our level of resources, a retail trader, towards a day trading as opposed to a swing trading approach?
Yeah, I mean, it depends how you define swing trading. I've been doing a bit of swing trading. It's hard for me because my philosophy is trading should be a full-time endeavor. You really got to give it your 100% concentration, and it's very hard to do that in my current role. Nevertheless, I can't stay away. So, I will swing trade, because obviously I can't scalp, I just don't have the time for that, using options usually in a Robinhood brokerage account at the moment, because I wanted to get used to the app and have a look at it and see what, I know it's very popular amongst retail. I'm just trying to get play around with different applications and things and get some ideas. Inevitably that view takes on sort of 2 or 3 days. So if we're kind of in that sort of same definition of swing trading, that's kind of how I work, and how I make those decisions are usually based on fundamentals, maybe a touch of technical, but it's more like, okay, what just changed in the fundamental picture? Is flip-flopping on tariffs? Well, that might drive price back up for the next 2 or 3 days. That kind of that sort of approach is the way I do it. But I think you're absolutely right. I think there is, obviously, the longer the trade time horizon, the more uncertainty there is in that trade. Does that mean that the person putting on that trade has more knowledge than you? Maybe they're doing more research, big research department behind them and things. They certainly have more capital to hold out that view and see, potentially go offside for a few weeks before it goes back onside. And that's very difficult for a retail trader. My career was day trading, more or less. As I said, about maybe 20% of my trading held no longer than a week, some spreads on overnight for a few days. So that's my comfort zone, and I don't really, I wouldn't put me in charge of a hedge fund's money, because I just haven't traded at those sort of time horizons. So I can't really speak to them, but I think you're absolutely right. From a day trading point of view, from what we have as tools in the market, with our technical analysis, our data releases, and a lot of watching the order flow. I mean, certainly that's how I traded. That fits a day trading time horizon better than a swing trading time horizon.
On the flip side, just throwing a devil's advocate here, a swing trader, which we can kind of define in these parameters as a bit more uncertain.
Yeah.
But uncertainty doesn't necessarily mean negative,
No.
or we shouldn't necessarily say that's a problem, because at the same time, law of large numbers, where you might have individual trades that are uncertain, but as a collective, you can find pockets of certainty or increased probability in random outcomes, which is the market. Giving the analogy of a casino, where you might get a gambler that loses life savings, and you might get a gambler that makes 100,000% in just on a a roulette or something. But the casino is not concerned with each individual moment, because they know they have a baked-in edge, and they just allow time to play out, because they know with large numbers they get uncertain outcomes each day, leading to certain P&L at the end of the year. Do you think that is the frame a trader should have in the market?
Are you saying that a trader should trade with certainty that over time it will play out?
And maybe even bouncing off your views on technicals, which is instead of trying to understand the market and read price and whatever, it's just a case of find a pocket of a pattern that you see repeating and look to exploit it. And you don't know why it's there, but over time it will play out. So don't worry about finding certainty in the market, or don't try and be too intellectual with the market. It's just find a pocket of an edge, like a casino, and allow large numbers to be in your favor.
Yeah, I think that speaks to a more systematic approach than I certainly traded. Mine was a more discretionary. Now there are definitely successful systematic traders. The return tends to be lower and not necessarily conducive with trying to make a living as a day trader. Trading is very personal, right? And everybody trades differently, and that's why it's very difficult to actually sit somebody down next to you and teach them how to trade, because they will have a different psychological makeup, different biases, all sorts of things going into the mix, which means that once you leave them alone, their decision making will be different to yours. And what you're talking about, I feel like, is like systematic trading is like, okay, I've found an edge, I'm just going to exploit an edge, it's going to win some of the time, it's going to lose some of the time, but over time it's going to pay off. And I think that is, I know it happens. I know, like in commodity futures trading funds, that they are systematic in their approach. But as I said, the return tends to be quite low and tends to work better in certain market conditions. I don't really see that happening a lot with traders, discretionary traders. They will tell you they have a playbook, they like certain setups, but that person can't write that playbook down and sell it for $19.99 or $99 on Instagram, like some people would like to lead you to believe. They're taking that playbook and overlaying that with a very strong risk management approach and psychological approach. And
would you add intuition into this?
I would definitely add intuition. And intuition's we call it gut feel, or we used to call it gut feel. And it's a very interesting concept because it's a hard thing to teach. But just to give you like a small anecdote, I remember standing in the pit and it wasn't much happening. And I was standing next to a guy, and he just turned around one day, almost seemingly out of nowhere, and he had a short position and he covered it, and he bought some. We were trading Eurolira at the time, and I was like, "Oh, why'd you do that?" You know, and then the market sort of rallied. Sorry, a few seconds later, the market started to rally, and I was like, "Why'd you do that?" He goes, "I don't know. I just had a really bad feeling. Just had a feeling." You know, and I'll never forget that. And then when I found myself in China, and I was working with my mentor there as well, who owned the company. He was my trading mentor throughout my trading career, and he'd gone on to build this trading group in these emerging markets. And he would talk about gut feel to traders, and that you should learn to listen to your gut.
Oh, really?
Yeah,
Okay.
you should learn to listen to your gut in trading. Now, what is gut feel? Well, really, it's a manifestation of your experience, right?
You basically got subconscious competence, and you're on a subconscious level analyzing or noticing patterns.
Yeah.
And okay.
Through experience.
This
So
is
that
going to be
hi-
my caveat of
yeah.
like, who has the right to deploy their intuition?
So this is interesting. So we would like talk to people about gut feel as part of the training, and then literally I'd have a 2-week in trader do something, and I'll say, "Why did you do that?" "Oh, my gut told me to." And I'll be like, you know, okay, that's not quite what we were on about. Okay, back
Yes.
to the drawing board. How do we articulate gut feel? And I think what's happening there is trading can make you uncomfortable. And Steve Ward talks about being comfortable with being uncomfortable. And, you know, particularly when you're scaling up as well and you're putting on position sizes that you're not used to, that's going to have an effect on how you physically feel as well as how you're thinking. And it's kind of like separating out, I think, that nervousness around having a position on versus getting an instinct that something's about to happen in the market, or, you know, and it's hard, obviously, you can't really articulate gut feel, but here's an example. If I think the market's going to sell off and I take a short position and it does nothing, I'm like, oh, it hasn't done what I expected it to do. And that might start manifesting itself in like, I'm getting a bit nervous about this. And you can actually feel that those nerves, you know, and you would act instinctively and cover that position. And I traded a lot on my gut throughout my career.
As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
I think intuition is something we speak about for hours. Here, there is also, like we spoke about earlier, of just the animal portion of us, survival instinct, or instinct is the word actually, instinct versus intuition, where right now we're having a conversation and I'm sitting here focusing on what's being said and thinking, you know, what to ask or what to say next. But I'm not thinking about moving my hands. I'm not thinking about breathing. I'm not thinking about the dilation of my pupils. There's a lot of things that go on unnoticed to us.
Yeah.
So I think as humans, we are designed to be focused on certain things, our analytical portion of our brain.
Yeah.
Then we have a huge portion of our brain that is just the subconscious, that is analyzing the environment or automatically running and so forth.
Yes.
And I think this does display in the markets where you notice certain tendencies. But the key here was what you touched upon, is like, who has the right to actually act upon it?
Yeah.
Because you might do an incorrect decision, but it led to a favorable outcome. So you kind of over leveraged on a trade, and it was a winning trade. So now you've reinforced the behavior of, if I over leverage, it leads to a positive outcome.
Yeah.
That's a false narrative.
Sure.
But on the flip side, you might do the right behavior and it's a correct intuition, and you enforce the right thing. So it's also analyzing, or should we analyze, how we assess what is intuition and try and bring it to the surface, or is a gut feeling with experience just something you feel like and you should act upon it?
Yeah, I don't really know the answer to that, I'm afraid, you know, because it is, you know, it's almost like so Harry Potter, you know, talking about gut feel, like an instinct, like, you know, use the force, Luke. And, you know, I just, as I said, you know, I can see it's hard to teach people when they've got no experience, and as I said, I would have traders like 2 weeks in say, oh yeah, my gut told me, after we told them to listen to their guts, and I think it comes with experience, comes with time. And of course, you're not always right either. And trading's, you're not operating in absolutes, and so it's not necessarily always right to you have that gut feeling. I'm long. It hasn't gone up. Something seems to be brewing. I just need to get out. I get out. It goes up. Oh, I was wrong to get out.
Yeah.
But I'd rather live with that than not get out, the market go down, and then be angry at myself, right? Because now I'm going on till, right? So that's changing the way I'm going to start to approach the market, because I'm like, you knew it was going down. Why didn't you listen to yourself? You're banging the desk, and now you're in the wrong frame of mind to trade.
So with this idea of just discretion versus manual trading, sorry, not manual, systematic trading. Yeah, I can completely see why systematic trading would lead to less returns, because the parameters are defined and the market is not perfect. So you'll be left waiting because you might have 9 of your 10 boxes ticked and you're like, I can't take this trade. So it's also the manual side is the discretionary side is understanding it's not fitting my plan entirely, but it's still good enough. And in my own experience, it's a case of I'll have certain parameters for my day trading. And time windows is something I look at. And there's certain portions in the day I believe are more volatile or more worthwhile, and I'll be entering on those time windows.
100%.
But if I have all of my boxes ticked and it's just like an hour or 30 minutes out of my window, it didn't meet the rule, but a bit of intuition tells me certain setups are worth going outside my time window. Other setups, let's say a counter trend trade or a hedge trade, it's not in my time window. It's a good setup, but it's not good enough. So I'm not going to deviate from my time windows. Do you think then discretion now becomes upon confluences, not a trade as a whole?
Well, I really like the way that you described like time windows and operating within and in and outside of them. And I think that, that you're demonstrating remarkable discipline. I know certainly I used to like trading the market open. I know a lot of my traders that trade, they like trade the market open. It's the most volatile. It feels like that's when some of the bigger market moving traders, whether that's a fund or an asset manager, are coming in, deploying their trade. And then as the morning goes on, the volatility tends to be sucked out. Obviously, it depends on the day, of course. It's not always the same, but it becomes less. When I was trading full time, it became less conducive to my style of trading. And what I would find is I would end up churning a lot more, making a little bit, lose a bit, spend money on commission, make a little bit, lose a bit, spend money on commission. But I found it very difficult to stop trading. And that was also part of the challenge. Okay. So I'm encouraged to hear that you have the ability to,
So it also depends because let's say the time window example. I'm trading a euro dollar and it's on the forex side. But a London Open and a New York key window I have. The London Open, I will actually allow a nice buffer because I know I have the rest of the day's volume to play out. Whereas if I now go out of my window, even 30 minutes on the New York window, I know within 3 hours, the London session is closed. The volatility dries up. It's not really going to my take profit that day. Kick over to the next day. Asia range might chop or reverse. So I don't know if that's intuition or that's just now me understanding probability, let's say.
Yeah, I think it's experience, right? And I think that something like that is less intuitive. I think that's just comes through experience and knowing exactly that's likely to be the scenario you're going to face. I'm going to be stuck in this trade now, and what's worse, in the Asian session, it might even drift against me, So I think that's just come through your experience. Some people like these quieter sessions. We have plenty of people trading throughout the night, and they like the low volatility and the slow drift of the market. I'm more like you, I like the sort of the more active parts of the trading day.
In your system, did you have non-negotiables that no matter what your intuition feels like, there are certain things that you just must act upon?
No, I don't think. No, I can't. Not when I was. No. I can't remember ever thinking. There was a time I was pretty much acted on everything,
We've all been there.
And for a while it pays off, but there wasn't. I find it very difficult. My experience tells me that there are no certainties in trading. So if you start trying to tie certainties to things, that's when you're going to get yourself into trouble. So if X, Y, Z happens, I have to do this. Well, X, Y, Z will happen. You have to do that, but the result is not necessarily what you hoped. But you'll continue to do that because that's what you believe is the right thing to do. And I think you just have to be a bit more flexible in your approach.
Are you a believer in, it's a buzzword, but market manipulation and kind of stop loss hunts, or these kind of price action patterns that we see that maybe are explained as manipulation, but it might be something else going on?
Yeah, it's a good question because I think there's less market manipulation today than there was. And I'll tell you why. When exchanges first went electronic, and in the UK that was around 2000, 99, 2000, and you first saw a price ladder or depth of market for the first time, right? TT, Trading Technologies, were the first people to, I believe they were certainly the first to patent the way you display a market depth on a ladder, or depth of market, sometimes it's called. We used to call it ladder back in London in the early 2000s. And it was kind of like, oh, wow, I can see where all the orders are stacked. I can see where everyone's working limit orders. That's really useful. That's very handy. And you could use that as edge. And so you would spend a lot of time studying not just what's trading at the bid and offer, but what's resting in the order book. And over time, markets evolve,
Spoofing
and
came around.
and people started to understand, banks and brokers who were charged with executing large orders began to realize, well, perhaps we should, instead of putting 1,000 in or 500 in at the offer, we'll put in 5 clips of 100, or we'll get more sophisticated, put 10 clips of random sizes.
To mask their order.
To mask their order, to hide their order. Then iceberg orders came in, which are orders that you can't actually see in the order book, but when it trades there, they're automatically entered. And then, with that became market manipulation as well. And that's when a lot of spoofing started to happen. And it was really around sort of 2004 to about 10, 12, maybe even into 2014 a little bit. And what happened was the exchanges started to clamp down on that because it became a form of price manipulation, and people started to get prosecuted for it. And what we saw is plenty of prosecution at the exchange level, and then we started to see prosecution at the regulator level that carried bigger fines and sometimes custodial sentences. The famous one being the Wolf of Hounslow, the guy that had manipulated the flash or was blamed on the flash crash. I think it was around 2010. And for your viewers, Google it. It's a very interesting story. Guy sitting at home in Hounslow in London trading on TT, spoofing the market that caused the flash crash or allegedly caused the flash crash, and ended up being, I think he served time for it. Certainly was prosecuted over in the United States by the CFTC. So I feel like the exchanges and the regulator did a good job of cleaning a lot of that up. Now, that doesn't say it doesn't go on. You have a situation where you do have regulatory arbitrage. There's a lot of people around the world accessing the US markets. And I'm specifically talking about US markets, but it happens in all markets, I'm sure. But my experience is in the US market. So they're operating around the world, and their trading does fall under the jurisdiction of the exchange and the regulator. And they have the power to ban that person and fine that person. Whether somebody sitting in China is going to end up in court in the United States. It's enforceable, but whether it actually happens, I don't know. So I'm convinced that a certain level goes on, but it's not as bad as it used to be by a long shot. Now, the question is, every time I put my stop in, it seems to get triggered. Is that a stop hunter? That's potentially could be happening. That's not a form of manipulation. That's a guy with an edge, like trading, knowing that, retail traders are putting their stop behind.
Retail psychology, yes.
Yeah, retail psychology and market psychology. So that definitely happens. You as a trader, you live with market paranoia, and you live with, they know what I'm doing. Every time I go long, it goes down, and to the extent where we used to sit in trading rooms and sort of shout out, yeah, it's definitely going down now, definitely going down, as we'd put a long in, to try and like counter this like thought that somebody was listening to us or watching what we were doing. And, of course, it just doesn't work. I feel like what you, well, not you, but what a trader sees, what a retail trader sees a lot of in the markets is their own behavior, right? They're going in at the same places, they're entering at the same places, they're exiting at the same places. So the markets are naturally, coming down, the stops are being triggered, they're out, but so hundreds of other retail traders, and then the market's just exhausted there and returns, or comes back, and you're like, damn, I got out at the low, or the low of that move. Why me type thing. And I think that's because, if that's happening to you a lot, then you just got to look at your strategy and think about, okay, I'm not going to put my stops where my strategy tells me to put my stops. And try and make some adjustments accordingly. But I think, what you're talking about a little bit is there's definitely manipulation. It's not as bad as it used to be. I don't think it's enough to lay the sole blame of your failure as a trader. And I think what you actually see more than anything is just your own behavior being replicated by people who have very similar views. You're all watching the same 5-minute chart or the same 1-minute chart, or you're all following the same system, whatever it is you've learned off YouTube. And that's, there's only so many people that could go into that trade. There's only so much liquidity.
Mm-hmm. I think it's also like the same price action. People can explain it in 1,000 different ways where one person might see a head and shoulder pattern, another might see a wick-off distribution pattern, another person sees God knows what. So, but it's the same price. It's just people's reflections, or they're imposing their beliefs on it. I want to speak about now profit-taking systems, because when it comes to an entry, I think there's a lot of components that we've spoken about: technicals, fundamentals, data, intuition. It's a mix of things. Yeah. Do you think that level of intellect should be applied to also the exit? Or because this is something I used to do, where I put out key levels of like, okay, am I go for the Asia low? Am I go for a structural low? Am I go for this support level? Am I manipulate that? And then I would have 10 lines on my screen, and I didn't know which one to pick. Yeah. So then it would be a mix of emotion or seeing how it reacts on the level. But then it's just greed coming in. It's like or fear, depending on where I am in my account. Yeah. So then I deviated towards just fixed profit levels, and I went through a data and I went through a long process, but coming to find out, what I essentially did was I just took my average session volatility or average session range and average daily range, and that was my TP1 and TP2. Yeah. Therefore, I don't have any discretion involved anymore. I don't have any intellect. It's just, what does London session average move? Okay, so this many ticks. That's going to be my TP1. What is the average day move? This much. Okay, that's my full TP. Yeah. Do you think that's a more sensible approach, or do you think having a discretionary approach would be more fruitful? Yeah,
again, every trade is different. I'd like to ask you, how do you exit TP1, TP2? Do you work limit orders?
Yes.
So you got a limit order in the market, it gets there. Have you ever thought about
waiting for a reaction there?
No, when it gets there, instead of having a limit order, so say your limit order's at 35, you're along from 25, it's trading 34.5. Have you ever thought about just putting a 32 stop in and let the market take you out?
And just trailing it?
Yeah, like a trailing stop, or essentially it's a trailing stop.
I did actually try it. So initially I tried let me arrive to the zone and see if I see indecision or reversal. Then I know I should get out. But then I realized there's an inefficiency there, because I am lower time frame trading. A small reaction, it might eat up 20% of what I could have taken. Yeah. So then over time, that me waiting to see, it felt like I was just eating up profits. That if I just had a hard level, the trailing stop is an interesting one. What I have found is my edge, I feel like its strength is I'll have a 1 to 3 risk reward partial, and it'll be around the session volatility. Yeah. And I'll take 50%. So if I'm doing 1% risk, I'll get 1.5% on a kind of session reaction. Yeah. So I then found out that I don't really need to care about the trend. I don't really need to care about any concepts. As long as I can find a high probability reaction, the likelihood I get my 1 to 3 or stop loss is very high. Yeah. So I end up becoming a reaction trader as opposed to understand the fundamentals and so forth. So the reason I explain this is because my approach is get in, break even as fast as I can, and aim for my TP1. Yeah. And if I trail it, it might also reverse on me. And I would rather just grab the level. But it's an interesting thought as well.
And this works for you?
Yes, and now an interesting reflection on this, because I've been doing this specific approach for about a year and a half. I found that my TP1 level was hit disproportionately more than my TP2.
Right.
So it made me think, okay, instead of me now actually going for the TP2, the average daily range, why not just full volume at the TP1? And then the trailing stop after the TP1 has been a consideration, or has been segmenting between these trade types. I should be doing full volume at 1 to 3. These trade types are more favorable for both TPs.
Yeah.
So this is actually a current dilemma I'm facing right now, or a challenge that I'm trying to find an answer to. But yeah, I thought I'd throw it out there because this is something that's been on my mind a lot.
Good luck finding an answer.
Okay. Why do you say that?
Well, because every trader's different, you know, and I'm loath to coach or advise a trader who's having success, because I don't want to break that success, right? And everybody's different. One of the things that I traded interest rates and interest rate curves, and they're very tight. So you would trade them in large size, but for very small profits, maybe a tick or two, you know, but it wouldn't be uncommon for me at the height of my career to have like maybe 1,000 or 2,000 contracts on. So, you know, you're really just looking to take a very, very short profit, small profit, but the very, very stable markets. And then as I've moved over to the retail and started playing around trading indexes, you know, these are products that can move, like really, really move. And one of the things that having a set take profit level, you know, I've questioned and gone through is that, what are you actually saying there? It's almost like, for me, is it like, do I have the arrogance to say that's where the market's going and it's stopping? And I know that, so I'm going to put my take profit in there. And the other thing I found is like your natural inclination to have a level where you take your profit is usually something technical, right? So it's like an obvious level of resistance, for example, if you're long. If it breaks that, it tends to really go, stops the other side, accelerate the move. And I want to be in that if it breaks that level of resistance.
Hence your suggestion of just trailing it.
Right. So I like to think this way. I think it's going to my TP1. But who am I to say it's going to stop there, right? And so let the market take me out. But as a result, you end up giving, you know, because quite often it's meeting a little bit of action there, and it might flush you before it continues. Most frustratingly,
that was going to be my point of like, okay, the trailing stop, it is a good idea. I haven't tested it, but I'd be interested, because let's say if we just use Fibonacci, Fibonacci retracement, we know the average retracement or pullback, which might be your TP and then a pullback and then continuing in your direction.
Yeah.
So then having your trailing below the 50% fib is probably not favorable, because you'll more likely just get tapped out. But if you have it at the higher level fibs, then you're more protected. But then if it does reverse on you, you ate up a lot of your profit. So there is a pros and cons here. So how would you tackle even correctly implementing a trailing stop?
Yeah. So it's a good question. Again, a lot depends on the product you trade and the volatility, you know, how much you're comfortable giving back, how far away from your break even to your profit target it was. You know, it's almost like, you know, for me, it's almost like a discretionary thing, but it's not. What I like is a hybrid approach. That's where I was getting to. Okay. Is like, what I found I've liked moving over to sort of more like markets that are moving, you know, at distance, like NQ or ES, is that I think it's getting to my take profit, or I'd like to see it get into this zone. I'm going to take some off the table, and then I'm going to try and run the rest, because I think one of the most frustrating things for a trader, and I hear this a lot when I'm mentoring traders, and when they're showing me their trades throughout the day, and they're like, you know, I shorted it here, I bought it back here, and then the whole thing just went on to collapse, and I'm so mad. And only if I'd done this, and only if I'd done that, and I'm like, you want to put yourself in a situation whereby if it does, I think you want to put yourself in a situation, if it does evolve like it evolved in this example, you're still in a position, not the whole position, right? Because, you know, you've taken off half or 3/4 of it, because your data and your trading and your experience tells you that, you want to be out at TP1 in your example, right? You're getting more TP1s than you are TP2s. But at the same time, there's nothing more frustrating than being out of the market when it continues to move. And I think at that point, it's not necessarily about the P&L, although the additional P&L is nice. For me, it's almost avoiding
Frustration.
the frustration
Yes.
and the toxic mindset and emotion that will then knock on from that and have an impact on my further impact on my other trading.
Maybe it's down to an individual temperament, but that frustration you're describing, of course, exists. But the frustration that is more for me is the risk to reward of holding a trade. Or let's say if I leave a symbolic runner position and just let the market do its thing, it will also reach a point where the risk to reward for me to continue to hold that trade is getting worse and worse, because I might now be up, I don't know, 2% on my small volume, and that I'm technically allowing that to come back to break even. In hopes of gaining a small increment, and therefore a negative RR to hold the trade. And for me to say, I was hoping it would go here, I'd gain a little bit more, but now I gave back a lot. I guess the trail is the solution to this.
Definitely. I wouldn't put yourself in a position to see a trade on side, take half of it off, and then let the rest scratch. I think you like you say, then where's the risk reward there type thing. It's more about, rather than being direct and saying I'm getting out here because I believe the market's not going any further from here, is like, I'm just going to leave some on and just see if it runs. But if it starts to come back, I'm going to be out quickly. I'm not going to give it all back to my break even on this.
The last kind of topic I want to touch upon is risk, because it's a big debate almost that I've had on the show with many guests, where certain people are very on the intuition side of things, and they're like, when you feel it, when you notice your A+ setup, risk aggressive, and it's around the frame of 80% of my profit comes from 20% of my trades. So knowing when to size in. The other thing is, you can also mess that up and over leverage and gamble and turn into a lot of problems even. I've always been just static risk, and people have proposed it to me, well, how are you going to scale? If you're just always going to be this 1% trade risk, when you have this great trade that is A+ that you've seen time and time again, it's the data's there, why not put 3% or 5%? It's just not been my way. But I want to kind of hear your thoughts on dynamic risk.
I think dynamic risk is something I used. Of course, if you're using static risk, you can scale, and I would use
scaling through capital,
scaling through more capital. And I just want to touch on something that doesn't directly answer your question, but is very related to risk and day trading, because it's something that was taught to me very early on in my career, and I think is relevant today, 30 years later, and I think can really, really help a trader. And that is, try not to lose more in a day than you can make in a day. Right? And I'm going to just walk you through why that's important as a day trader. So let's say, and over time as a trader, you start to get a sense of what an average to good day is for you. Let's say that's $1,000, right? I can make $1,000. You have outlying days where you might make 3, but on average you make about 1,000. What you want to be in a position is not to try and lose more than 1,000 in a day. So because what will happen is this: on Monday you come in, let's say you lose $1,000. Well, on Tuesdays you come into trade, you're like, well, I know I'm capable of making that. So if I have a reasonable day, I'll be flat. And then, Wednesday might be a scratch day, and Thursday and Friday might be profits. And, I'll make money on the week and I'll feel good about my trading. Whereas if you're capable of making, on an average to good day, about $1,000, and you come in on Monday and lose 3, on Tuesday, your mindset's very different. Right? Now you are like, I've got to work all week for nothing. I've got to have 3 of my reasonably good days out of the next 4 just to even be flat on the week. And that changes everything. And, and as a manager of an online prop trading group that services retail traders, the number one mistake is people over leveraging the accounts. Now,
On a single day, you mean?
Yeah, on a single day or on a single trade, on a single trade too. And I'm not naive. I know that there is a significant subset of our users who are here to play the online prop trading odds.
Just
right?
the casino idea.
Like the casino ideology. And that's fine. There are also a subset of our users who are really interested in learning to trade, wanting to become good traders, make a living out of trading, make a career out of trading. And, those are the ones we sort of like work with and try and focus on, and we create the content for, and those are the ones that consume the content. But I really like this philosophy of trying not to losing more in a day than you can make in a day, because big losses can really, really cripple you. And in around sort of 1996, I had like one of my biggest losses throughout my whole career, actually. There were a couple that came close and probably one or two that exceeded later on. But in terms of where I was in my career at the time, it was very significant. And I would say like a good day for me was around $2,000. I was in the UK, so it's pounds. It was actually in lira, but converted from lira to pounds, it was about £2,000. So bad days about $2,500, and I would probably make money 3 days a week, scratch one day and lose one day, maybe 3 losing days a month, 3 or 4 losing days a month, and there was a whole story behind it which I can go into, but I don't know if we have time now. But I was basically coming off a really good run and super, super overconfident. And I came in the next day knowing what the market was going to do, or at least I thought I knew what the market was going to do, because I was trading so well. And technically, it opened the previous day, it opened on the high, closed on the low, a lot of volume. I was like, this thing's going to crash tomorrow. And I want to be in it. I want to ride it. I want to go short. And on the open, I just started selling. Selling. And the market didn't move. Stopped, it stopped. And I was like, oh. And it started to tick up. And then the liquidity dried off. And I was like caught, and I was caught big time. And I was scrambling to try and cover it and hedge it. And, by the time I'd unwrapped myself from this whole mess, and we were on the trading floor, so I was filling out trading cards with my prices and contracts. The market opened at 8. It's about 8:30 a.m. So I've been trading about 30 minutes. And I went round to the booth and gave them to the runners who normally collect the cards from you in the pit and type them in and match them through the system. I gave them the cards and they typed them in. And I said, I'm going home. You can call me, when you've figured out first of all, that I'm flat, what my position is. It should be flat, and let me know what my loss is. And I walked home that day. I was living in London, but it was about an hour and a half walk from the exchange, because I just felt sick. I just couldn't face getting on public transport. And I kind of got home and I got a phone call from one of the runners, and they said, yeah, you are flat, James. Everything's good there, but we think we have an out trade. We think we've typed something in wrong. So it's a very manual process. So you had the trading cards, and they would read your handwriting, and they would type it in a machine. It would match with the other traders' back office typing it in. And sometimes you have what's called a mismatch or an out trade, where something may have been typed in wrong. And they said, we think we've added an O in somewhere because we're showing you down £27,000 and we assume it's £2,700.
Wow.
And I was like, no, it's £27,000. It's right. You've got your cards right. So I knew it was bad.
You just got on tilt. Okay.
Yeah. And I just in that half an hour, took this massive loss. And I would say it took me probably 2 months before I started to recover from it. And I'm not recovering too much, start to recover. For weeks, I couldn't even trade. I was afraid to trade. I would go to work, I would stand in the pit, and I would be afraid to take a position. Initially, I started taking like 50 lot positions and 20 lot positions, which was kind of the size I was trading before. And I couldn't hold on to them. I was too scared, because I couldn't afford mentally or, financially to lose any more money. So I wouldn't let the trade play out. I was cutting it too early. It was too much size. It was just awful. And I was paralyzed through fear. And I would sit out of the pit and sit on the steps and just look at the trading action. And I couldn't move. And it was like that for a number of weeks, more or less. And I would go in and try and, maybe make a couple of £100 and lose 500 quid. And, I was just getting nowhere. And one day I was sitting on the steps, and one of the floor managers came over to me and said, I know you're really, really struggling mentally. He said, he opened his wallet and he said something like this. He said, how would you like 50 quid? And I was like, oh, yeah, that'd be, that's great. Thanks, Ricky. Why are you doing that? He goes, well, I'm not going to give it to you. He goes, but go and stand in that pit and trade a one lot and trade two or three times and see if you can make 50 quid, because I know you can. And I was like, okay. And I went in and I traded a one lot and I traded 2 or 3 times. And, I don't know if it was 50 quid, but it was close, right? It's like 40 quid. And I came out. And the point is that I came and finished the day profitable. I traded 2 or 3 times. They were winning trades, and I could feel things shifting inside me. And I immediately got the lesson, and the next day I went in and I traded 1 lot. And the day after that I traded 2 lots. And the day after that I traded like 5 and 10. And Ricky come and tapped, slow down, but 3 or 4, 4 or 5, just take your time and scale up that way and build your capital back that way. And it took a long, long, long time to recover. And then I went on to do better than ever. And that's a huge lesson as well. Lots to draw from that, but ultimately as a trader, what that did is it gave me the confidence and another tool in my toolbox to know that I can recover from a very difficult situation. And circling back to what I was saying at the top, which is about trying not to lose more in one day than you can make in a day, it kind of goes to that sort of like that philosophy is there are 2 P&Ls when you trade. There's your cash P&L and your confidence P&L. And the confidence P&L is more important than the cash P&L, And one of the other things I learned at the time was a trader that worked in our firm. I walked off the floor after a really violent move in the Euromarks, and the Euromark was the European interest rate curve, not the euro, not currency pair. It was an interest rate curve, and there was something in the German money supply that had caused a big shift in the curve. And it was a huge day, and I walked off the floor with a trader, and I said, "How's your day?" He's like, "Oh, it's really good." I was like, "Really? How'd you get on?" He goes, "I lost 800 ticks." And I was like, it's about 25 euros a tick, I think, at the time. So it's a significant amount of money. And I was like, did you say it was really good or really bad? And he goes, no, it's really good. He goes, because I traded incredibly well, and it could have been 10 times worse. And I'm so proud of the way I traded. And it was clear that trader was big enough to be able to handle those types of losses, that it didn't impact him mentally, and he could continue to trade well. He could save his P&L, he could get out of his position for him, a risk managed loss. And he's feeling good about his trading, and he can come in the next day and work on getting it back. Whereas for me, when I lost that sort of money, I wasn't prepared for it, because it was much more than I could make in a day, and it was much more than I could sort of see any light to the end of the tunnel. So again, circling back, when you're sitting down and, an average day for you is $300-400, try not to lose more than $300-400 in a day, because if you do lose that, then you just have a reasonable day the next day and you're back. Whereas if you use 3 times that, you're going to have to go through 5 or 6 trading sessions before you break even. And that is incredibly demotivating.
It's very interesting, because I think if I was faced with a similar situation, which I have been actually, my instinct is to fight. I'm like, I need to win this back ASAP. And sometimes I feel like it has to be today. And you just end up going on tilt, and then you get out of this mental state and you're like, what did I do? And it's interesting to see that you had your similar experience, but that almost paralyzed you to not take any movement. I want to end the show with a question that might be interesting in your position, being in the online prop space, which is, in the end, a goal of a trader is to make money. And now when we're speaking about risk and blowing up big numbers and the psychological impact it can have, that is obviously to the detriment. Especially when it's large numbers, which is amplified in a prop firm scenario, because is maybe demo or whatever the case may be, but you're seeing big numbers on the screen, bigger than you're used to. Otherwise, you wouldn't be on online prop firm. But then the people that are here just to make money, and they don't care about this perfect trader philosophy and a long-term track record. They just want to, kind of flip the coin and just payouts versus buy-ins, valuations versus payouts, let's say. And if they have a risk reward there, they might spend $5,000 on challenges. They might get 20K in payouts. They might blow a bunch of accounts in the meantime, but they made money. How would you respond to a trader who is trying to take that approach, especially because there is plenty of traders online that are doing that successfully?
if we step back, when we set up Trade Day, it was in 2020 before there was this huge wave of competition and people doing this in the space. Before, what I would call this phase of the maturing of the space happened. And for us, it was about crowdsourcing a successful trading group, trying to find the needles in the haystack. Fast forward 5 years later, and I know that that's only part of our business. The other part of our business is the entertainment business, the entertainment aspect, the online casino almost, and that there are a subset of our users who are here to take advantage of the prop firm structure and play the odds. And there are a subset of our users who really are interested in becoming successful long-term traders. And the problem is, I think, where those two intersect and social media. And I feel like there are a lot of influencers in the space who are portraying the toxic flow, playing the prop firm odds, portraying that as being a successful trader, and it's not. And if the prop firm space ever went away, or a trader was unable to operate within the prop firm space and had to do it with their own money, they wouldn't be able to do these types of trades.
And they're stuck with bad habits.
Bad habits, So, we create a lot of content on our site for people who are genuinely interested in becoming successful traders. We try and manage expectations. We try and provide tools that will help people find their edge. And that appeals to the group that are interested in becoming successful long-term traders. But what I would say to that group is, ignore a lot of the action that's happening on YouTube, the account flipping, like you say, the quick, fast payouts. I mean, the people that are in our live trading, our A-book, and the people that are doing well are the people that have built up their trading accounts. We have one trader who I'm in contact with in the last few days who got his account up to about $150,000 in the A-book in the live market. So, it's great. We're aligned. We're trying to help him. But every time he hits 150,000, he starts to fall back. And he's reached this kind of like psychological ceiling that he can't go beyond. But what I see in his trading behavior is excellent. So he falls back. And these what I call ceilings in your trading account are very common. Happen to me, happen to many traders I've managed over the years. You get to a point you just can't seem to get beyond. And your P&L seems to fall back. But what I like about this trader is he does the right thing. He immediately scales back his position size and recovers slowly, and then the problem is once he starts getting up towards 130, 140, starts increasing his position size, looking for the big trades to break through, and he hits the ceiling again and falls back. And he's fallen back about 4 or 5 times. And I reached out to him to see if he wanted to have a chat about it. I'm still waiting to hear. Hopefully the end of this week, we're going to get together. But this is perfectly normal behavior, and this is stuff that we want to help these traders through. But the one thing that's common about this trader is, or the one thing about this trader versus the account flippers is that his approach has been, I'm not going to take quick payouts. I'm going to build my account. I'm going to take the appropriate amount of risk for my account balance. And that's what's led to his longevity and his growth. And what we see typically with people who are blowing accounts quickly, who are funded and get into a payout situation, is they'll make some money and they'll want to take 50% of what they've made. And I'm like, well, it took you 3 days to get there. So essentially what you're going to do is leave enough money for a 1-day loss. And, sure enough, you're going to hit that 1-day loss, 2-day loss, and you blow the account. And it starts, they're in this sort of cycle of flipping over. And, that is in itself a strategy for some people as well. But nothing makes me more angry is then to see this person, blasting all over social media, I took these 4 payouts, look how successful I am. And I'm like, well, I haven't seen anything in your trading that suggests to me that you're a good trader, so don't buy his course, that kind of thing. But it is something we have to live with running a trader evaluation service. It's the way, the way that it's set up means that there are ways that you can exploit the industry to your own gain that you wouldn't be able to do if you were trading your own capital. So we just have to live with it.
Amazing episode, and I just want to say thank you. I'm sure everyone loved the episode, and thank you for giving us the opportunity to hear from your experiences and thoughts.
Thank you. Thanks very much.
Amazing. Boom. Excellent. I really enjoyed that one. That was a lot of fun.
Good. Excellent.